From my side, a very warm welcome to this third edition of the Swiss Value Day. My name is Müller. I'm from BWM, and I'm extremely happy to co-host this morning together with Alex Rauchenstein. He's the CEO of SIA.
Good morning.
The two of us, our two firms, launched the event a couple of years ago because we felt that value investing deserved more limelight. The style had been struggling for quite a while, but both of our firms, who've been at it for over 20 years, felt that the auspices for a rebound were good. Thankfully, that is what we've experienced, particularly the last 12 months or so. It so happens that both of our value strategies had quite a strong 12-month return since the last Value Day. And we believe that the upside remains very attractive. With this particular context, we'd like to showcase the broad appeal of value investing. Georg von Wyss, who co-founded BWM in 1997, in this period accumulated the wealth of investment experience from which he has picked some highlights to present today. He will be followed by Marcos and Hernandez, who'll showcase his wisdom by drawing from the wealth of experience of the late Charlie Munger. He'll be accompanied by Eva Vidal and Daniel Segaro from Grifols this morning. To showcase the broad spectrum of value investing, we're extremely pleased that we've again been joined by two fantastic value managers. From Paris, we have William Higgins. He's the president of Indépendance Asset Manager, who's been successfully investing in French and European small caps for 30 years. And from Munich, we have Stefan Reder from Value Intelligence Advisors, whom he founded in Munich. And he's been a long-time investor of a global value strategy that's been very successful and that's distributed in Germany. Both of them will join Gregor Mast from the market, together with Marcos and Georg, in a fireside chat on value investing after the two presentations from Georg and Marcos. After the break, Stefan and William, and also my partner Lars Jakob Selsas from BWM, as well as Alex, will each present an investment case to showcase how they go about value investing as analysts. In a bit, to make this as interesting as possible for you, the audience, we decided this year to change the format a little bit, and we'll make it as a so-called round robin, where another analyst will start the questioning to the presenter. We will then hopefully also have some time for you, for the audience, to make it interactive. A few words on our firm, BWM. There are 6 of us who focus entirely on managing 2 value funds whose portfolios effectively are very similar. The investment team, 4 of us, have been working together for almost 20 years and consist of Georg von Wyss, whom I've already mentioned, Lars Jakob Selsas, whom he'll hear later on, as well as Markus Kausen and Pascal Prüss, both of whom are also here today. And then our COO is Daniel Jordan, also here today. We've been at it for over 26 years with the Classic Global Equity Fund. And we're all substantially invested in the funds ourselves and set up as a partnership, hopefully to align ourselves as much as possible with our clients. I very much hope that you enjoyed today's program, and I'm very glad to hand over to Alex.
Also a very warm welcome from my side. Most of you already know SIA, but let me just bring it again to the table here. In a nutshell, we are a value boutique, and we basically manage 2 funds, a natural resources fund as well as a value fund, since 22 years. We are 8 people in total and 4 investment professionals, and the returns that you see here, the 9% per year since 22 years, is in euro. And that brings me to the point, the fact sheets that you have from our friendly competitors are in Swiss francs. So there is, of course, a difference already there. And I think that is at least makes it the reasoning to look at both very nicely. And I always say it's worth to invest in a couple of value managers, because sometimes these guys have a good run and sometimes the other ones have a better run. That is our investment committee team. We are the 4 of us, 3 are here. Carlos is today in Geneva, he could not make it, but he best regards. We are working together for 20 years plus. We are extremely motivated. Also, because actually Carlos decided to step down a bit with his large position in SIA and to divide it among the partners. So we have now, since 2019, equally weighted partners, and that motivates us even more. And again, we have all our money invested in our funds. Now, you're no, it's not working, the change. Ah, now it does. Okay. I just wanted to talk about AI. And you're actually not in the wrong presentation. I'm pretty sure AI would do that much better than me, because I cannot even see my mouse now. I cannot close it. Okay. Because this is the dominant theme in the market. Now, ladies and gentlemen, you're not in the wrong presentation here. Because we are not going to talk about NVIDIA, unfortunately. Actually, we were looking at it once, and we have not bought it. Okay, now it's gone again. So but what I want to tell you is the following. Imagine you go back to the late 90s. Do you remember the first internet provider you had? In my case, it was CompuServe. And CompuServe, when I opened it up, it did some funny noises. For the young ones, it's on the, they could not imagine that. And then finally I was in, because it was worldwide waiting until you got there. Now, McKinsey at that time did a study that internet will be a big revolution for the world, which it was, and is. Out of these 150 internet providers, not one actually did really make a lot of money. What do I like to say with this? Now, you have a big theme. You have an obvious winner at the moment, but I'm pretty sure that the competitors are running after this high return on equity. But the situation is, how long will it last? And it's also not clear where it will then show up as being a part of profitability gain. Because autonomous driving was a big theme 4 years ago. It went that far that my youngest son, which is now 6, at that time he was 3.5, asked me, Alex, Daddy, do you know when Oma is coming by an autonomous car? Because she's 90 and she cannot drive any longer. And then I told him, you only maybe need to wait a bit. Now this big theme that was mentioned in all the presentation and fund fairs up and down, it has stopped being there, but it's real. It's real in an old economy like mining. Now the truck to the right bottom is a truck from Rio Tinto, and you basically save as Rio Tinto 190,000 Aussie dollar. Now there is no kid running after a ball. That's why it's working there. And I think that's going to be a very interesting situation to see who is going to be the winner out of this AI situation. And with that, I already overdid my time. Sorry for that, but I think it was also a technical issue that I could have as an explanation. I would like to pass on to Georg. Thanks a lot.
So, Urban, to his credit, and his job is to marketing. So he said we're going to talk about highlights of our investment practice. I'm going to actually talk about some lowlights too, and through the contrast of things that worked and not worked, show some of the pitfalls as well as the advantages of value investing, to give you an idea, maybe for yourselves as well, as to how the process works and certainly how we work. What I'd like to, this is useless, okay, very good. Okay, so I'm going to show you how value outperforms, but not all the time. You know that. And then we'll talk about what makes a good value case, and ex negativo, what makes a bad one. So why we're still in business, why we've been at it for all these years, is because over time, value clearly beats the market. What you see here is the Fama-French factors, as you can pull them off the internet. The lines are the following. In orange is the market. In blue, the top line, you see the small cap value. And you see that if you start with $100 in 1951 and you use a value strategy based on price cash flow, you end up with something over $200,000 and compound at 11.2% when the market. But with a small cap value strategy, you compound at 16.3%, which gets you to $6 million. Big difference, the magic of compounding, and of course, lots of time. Large cap value is the green line. It's also pretty darn good. It's awfully good. And the bottom line, the gold line, is large cap expensive stocks. So those are the ones that have dominated the markets in the last years, the ones that have made all the performance, the ones that account for all the capitalization. And if you look very closely, you see how the gap between the market and large cap value has closed in the last 10 years. But that's the point. You have to look very closely. It's not the normal pattern. What is the normal pattern, in our opinion, is that value outperforms, and when you take the small cap effect on top of that, then you have a terrific combination. Now, why does it work? What are the reasons for it? Well, as we know from the metaphor of Mr. Market, he's irrational in the short term. He thinks in stories, exhibits psychological biases, and extrapolates from the past. So he's subject to herding, he's subject to over-optimism. Human beings are social animals. We like to do what most of the rest of us are also doing. It's hard to do something different. Mr. Market doesn't really pay attention to valuations that much, but he does love momentum. He kind of looks at valuation, but not all the time. Momentum is more interesting. And of course, we have the problem that professional investors are subject to career risk. As we all know, by December 31st, if you work for someone else, you have to put up some good numbers, otherwise you have a problem if you consistently don't do that. Now, if you take the long view like we do, because we're all independent firms, all of us here are our own bosses, we have opportunities because we can do sort of what I call time arbitrage. We can wait. We can afford to wait. And then take advantage of the fact that the market is pretty efficient. It values most shares correctly most of the time. Market efficiency is mostly true, but it's not always true, and we're looking for those exceptions. And to find those exceptions, we have a process that keeps us rational. All of us have a process. You'll be hearing about maybe some of the differences over the next few hours. As far as we're concerned, we have a framework that boils down to essentially three variables: growth, margins, and valuations. Growth would be sales growth, how much profit you get out of those sales, and then how that's valued. Another part of our framework, and you'll see why, is that we don't want much financial leverage. And then I'll show you some examples, both good and bad, of how getting those growth and margin estimates works or doesn't work. I'll talk about asset plays, because we value investors are always associated with asset plays. And then I'll show you a case where it's a good thing that we do our own research. We were happy to have been in that position. Okay. So the way we work is we determine an intrinsic value for every position, and that's a function of the normal valuation. So what's the normal PE? What's the normal discounted cash flow value? What's the normal EBITDA multiple? And of course, to do that, you need to know what the earnings are, what the cash flows are. And there again, we're looking for the normal level of earnings, not when things are terrible, not when things are great, normal. And of course, if you have a cyclical company, that's harder to determine. If you have a steady growth company, that's easier to determine, because they put up steady growth. But in every case, ultimately it's a function of long-term growth, and it's a function of the margins that you can achieve. And like I said before, to determine the normal valuation, we look at the history of the company and the industry. And then we also do a discounted cash flow model to check. And what we try then to do is, if we say the thing's worth 100, we'll try to buy it around 60. I'm not saying we always buy at 60. Sometimes we pay a little bit more if it's super quality. Sometimes we'll pay less if it's bad quality. But 60 is a good value for orienting yourself. Okay, so why do we avoid financial leverage? Well, because of AA, which is a stock that we owned. Let me show you this chart on the left first that you'll see a couple of times in my presentation. This is the share price. You see this was not a successful investment. The solid line here is the intrinsic value as we estimated it over this period. And the red bars show you when we bought and sold. So what's AA? AA is like TCS. It's the Automobile Association. It's roadside assistance in the UK, which means if your battery dies or your car breaks down, you call them and they'll come and get you moving again. Very steady business, especially at the time that we bought it. The British fleet of cars on the road was quite old, so they were breaking down a lot. So operationally, they were in a good spot. The trouble is, AA came to the market with a lot of leverage. It was a private equity deal that was brought to the market, and we bought it after it had already corrected a good deal. But before management had established itself, and when they did, they said to themselves, "Oh gosh, we need to spend more on marketing." Typically, for private equity, they'd underspent. When they did that, the refinancing costs rose, the stock got killed. Then a hedge fund came in and bought it at a cheap asset value, but they said, listen, we can refinance it. You guys can't in the public markets, so you have no choice, and so we had to sell to them. So what killed this company is not the operations, it's the debt. Let me show you that with this chart. Here on the left, you see the EBITDA, so the operating cash flow. As reported, this is where we are at about the end of 2019, okay? So pretend you're at the end of 2019, you know you have 2 years behind you where EBITDA has been what it's been. And then we made our projections, that's in green, of where EBITDA would go, and then I've shown you in blue what actually ended up happening. So you see, we have a fairly steady EBITDA development. We were a little too optimistic, but we were about right in terms of the operations. So that wasn't the problem. But the problem was the following. In 2018, when the company announces that they're going to start spending more money on marketing and the margins would be lower, that increases the riskiness of the stock. It becomes harder to refinance it. And the blue line here shows their financing costs, so the interest costs that they're paying. So these go up and up and up, and the stock keeps coming down. And then, of course, you've got a spike because of COVID, which is corrected very quickly. But the point is that in spite of this wonderful business, this wonderful fundamental business, the stock gets killed, the company gets killed from our perspective as shareholders because of all the leverage. That's why we got even more careful on that score. We had made an exception with AA because we thought the business was so good it would support the debt. We were wrong. Okay, let me show you a winner. This would be H&R Block. H&R Block is a company in the United States that helps you fill out your tax returns, which if you've ever done that in the United States, you see why you'd need professional help, even for a small return. So it's a very steady business, but they were losing share to online. They were not online so much as software, do-it-yourself software. And they were losing share. They hadn't done a good job of marketing. They got new management. And the valuation was really cheap, and we liked the story the management was saying about how they were going to grow the company better. So we initially assumed that the company would still shrink, that it would grow at -2%, or shrink at 2%. But the market had 5 to 6%, and the P correspondingly looked very low. We were more optimistic. We valued the company higher. We gave it a fair value PE of 9, but the market was saying, no, 6.6 is correct at the current share price. Ultimately, the management does do its job. It does very well. It realizes the value of the franchise, and it actually grows positively. And as you remember from the Gordon growth model, you know, the value of the cash flow divided by your discount rate minus the growth rate well, if you get some very big numbers if you go from -2 to +3. So the value of the stock expanded hugely, and we did really well on that one. So this is one of those cases where if you get the growth rate at least directionally right, better than the market, you outperform. But of course, you can blow that too. You can screw it up. And that would be Credit Suisse, a stock where we did not do well. We thought that Mr. Tijan would come in and improve the cost structure, that he would show us that he would free up the value of the private bank. You know, he was an Asia expert who had done great jobs with a great job with Prudential. Reduce the investment bank so that the value of the private bank would come out. We all knew that's a great business. But instead, the investment bank kept eating capital. It kept posting bad results. He never got the investment bank under control. And indeed, as we all know, they produced scandal after scandal. So in the end, CS was cheap for a reason. It was a value trap. The market was smarter than we were. We overestimated management's potential to fix things. We thought a smart manager from outside could do that, and it turns out that the culture was too strong for him, and maybe he wasn't that smart after all. Now, the value of patience is shown by a stock that we still hold. It's called Kelly Services. It's like Adecco. They're a temporary employment agency in the United States. And we've been in this one for a long, long time because the story has always been that Kelly was poorly managed. The business basically was okay, but they had way too much overhead, far too much. And we wrote to them 4 times saying, please, you guys have to do something. This is crazy. Finally, they paid attention and actually did something, and that was in 2023. And what convinced them, I guess, was this table that you see here. It shows the conversion ratio of the Kelly and its competitors. The conversion ratio is EBIT as a percentage of gross profit. And you see Adecco and Randstad are all well over 20. Manpower, which isn't a great company, was close to that. Trueblue, which is another small company in America, was at 13%, and Kelly was at half that. And that's embarrassing. And you want to send numbers like that to a board of directors because they don't like being embarrassed with this kind of fact. So they do start the cost cuts. And I think at this point, we're not there yet. The stock has started to rise, but I think that ultimately we'll end up with a company that isn't maybe one of the best in the industry, but that's good enough, and that should unleash an enormous amount of value. So the asset in and of itself, Kelly as a company, Kelly doing what it does, was actually pretty good. It was obscured by management that just tolerated too much overhead costs that they were able to cut. And so we actually like looking for those situations. I guess what we would rather do, though, is notice them later in their life and not earlier, and not wait as long as we've had to wait. Now, this brings me to the topic of asset plays, which are really hidden earnings plays if you think about it. The value of an asset, even if it's a piece of land, ultimately comes down to what someone's what someone can get out of it sooner or later, whether they can put a building on and rent it or God knows what, or maybe just sell scrap metal for money. So you have to, with every asset, ultimately you have to look at what the value is that can be generated from it. And like with Kelly, we saw that more could have been generated from that asset. And for us value investors, this approach is very useful when companies are complicated and have different businesses, because there the economics of the businesses can be very different in terms of growth, margins, riskiness. And part of what we want to do is look for unpack that better than the market, value it correctly, and then hopefully make some money. I'll show you a nice company in our portfolio right now. It's Quadient. Quadient comes out of the franking machine business. It's not a growth business. You know, we send less and less letters. So it's shrinking at about 3% a year. It generates a huge amount of cash. We value it at 5 times earnings. That gets us to a value per share of 18 euros. What they also have is client communication software, which is software that a big insurance company will, for example, use to manage the letters that they send you, the emails that they send you, just everything having to do with client communications. That's not a trivial process. And there are a number of companies out there offering this, and we know what the values are of those companies. Those are valued at 3 to 7 times sales. Now, this is not a business that is hugely profitable yet, but it is a business that's growing very, very fast. So a price to sales, an EV to sales multiple is probably a good way to look at, is certainly a good way to look at these things. We're conservative. We take Quadient's and value it at 2 times, and we get a value per share of 15. Then there's a third business which is growing, but it's not so important, and then they have some debt. So we come out with a value per share of 35. And you see the difference in the assets. Franking machines declining, hugely cash generative. Client communication software growing very quickly, on the cusp of becoming profitable, but not quite there yet. And the market kind of overlooks that. If you took that thing apart, it would be much more valuable than it's trading, than the current trading multiple. And you see that again on this chart. Our intrinsic value is much higher. By the way, I forgot to tell you, recently we've started estimating high and low intrinsic values to get an idea of the contingency of this whole business of estimating things, to give ourselves a better sense of where we could be right and wrong. So that's what those light blue lines are. But anyway, Quadient is very cheap. If we've estimated the growth rates and the margins of the segments correctly, then we have a great stock. If we're wrong, it's because we've messed up on the growth rates or the margins. The market, though, looks just at the net reported results and doesn't give it credit for the fact that the growth is going to start coming out soon. Now, how will this help us as shareholders? How will the value emerge? Well, one, we can just wait until the growth business starts making so much money that it compensates the shrinking business. That's about now. And the other thing is, of course, management could always split up the company. It has had offers for the software business. It's just rejected them. In retrospect, we're glad it rejected them because those offers were much lower than the value is today. But that can always happen. So the key is a sum of the parts analysis that takes into account the economics of the businesses. Finally, a situation where, how much time do you want? 3-4 minutes. Okay. A situation where we were ahead of the market just because we do our own research. It's Compass Group. Compass is canteens and cafeterias. As you see, we start during COVID. The company had traded at a PE of 22 times, but during COVID, of course, it wasn't earning very much money or nothing at all. The question was, what happens next? And we said, you know, probably in 2 or 3 years, this business will have come back. The pandemic will be over. Where was the market? Well, it's April 2020 when we're buying the stock, and here's the situation. You see on the right are the EPS estimates. The big blue line on the left is the consensus earnings estimate. That number's been coming down. So if you've been following that on your Bloomberg, you know that it's at about 120 pence, but it's falling. So you don't know how far it's going to fall. You're unsure. The stock price has fallen a lot more. And it's telling you that maybe the normalized level of earnings is something under 60 pence. But we looked at it and said, no. All in all, this thing's probably going to earn something short of £1 per year. And that's where the market ended up by summer. But that gave us the opportunity to get in and buy the stock and then profit as people regained confidence, and then the company started posting those numbers. So to summarize, we're trying to figure out what the companies are worth based on understanding the economics carefully, doing a lot of research on that front, and then valuing it correctly. That means, like it says here, we do a lot of our own research, and where we try to improve is we try to get better at gathering information and processing it and taking into account the risks. The problem is that we're always going to have mistakes. We try to learn from them, but you're always going to look at a portfolio like ours and say, oh my God, how could you guys be so stupid? Let me just finish on one thing on the market in general. These are the price-earnings ratios. On the left, America. On the right, Europe. In blue, the MSCI Growth Index. In green, the MSCI Value Index for those two geographies. As you see, growth is still a lot more expensive than value, but maybe we're starting to see a bit of a correction. And the PEs on European value in particular have not gone up very much, even though the stock prices have moved recently because people are raising their earnings estimates. But the point remains, for now, it's an awfully interesting place to be value because we're just so far away from the historical norm in terms of valuation to growth stocks. We're just way too far apart. So thank you very much, and I'll hand over to Marcos.
Okay, good morning, everybody. Thanks for joining the third Swiss Value Day here. Basically, I'm going to share with you also our experience. It's going to be from a different perspective than the one of BWM. Basically, I'm going to share what we learned with the crisis in 2008, the big global financial crisis, and I'm going to try to do some parallelism with Warren Buffett and Charlie Munger, that I think, we all have read them, but or personally, I have learned it in the hard way by losing money and messing it up. I'm going to cut my presentation to 15 minutes, and then I will introduce Grifols, because we presented them last year, and they had been under an attack from a short seller, and I think it's a very good opportunity to listen to them and also listen a little to us on how we deal with these issues. So I divided the presentation in 3 parts. Basically, value, the Charlie Munger way. So we finally understood it. Let me start with some, something that probably everybody knows. Buffett started, value investing in the 40s. He was really young. It's surprising, under 20 years old. And he started, as you know, picking cigar butts and just picking things very, very cheap with not a lot of analysis, just going through the pink sheets and choosing very, very cheap stocks on cash, on working capital, on equity. So traditional value, I would say. He was following his professor, Benjamin Graham, so probably all of us have read these 2 books. And this guy probably is, in my opinion, in my humble opinion, the pioneer of value investing. And just one thing, if this guy was the #1 in value investing, and then you learn that his priority was really art and women, you're a bit surprised of what kind of personality he had. So then came Charlie Munger. He brought a kind of a new way, new path within value, which I can sum up in investing good businesses. So they met in a dinner in the Omaha Club of Golf, I think in the 50s. I looked for the day, but I couldn't find it. And then they start talking 2 hours a week. So really, they fit. And these guys, over 75 years, they've been, the best story from the value investing perspective of the world. So this is our long-term investment fund classic, started in 2002, pure value, so more aligned with young Buffett, picking very cheap stocks. We move up a lot because the right moment was 2002. After the tech bubble, the valuations were cheap, value was very cheap, and it was the best fund in the world, one of the top funds. We went from 5 million assets to 2 billion. And then the crisis came in 2008, 2009, as we all know, and we really messed up. So the first 6, 7 years, we did 30 points of alpha per year, and then we fell very hard in the global crisis. We didn't really lose money. So you see, we went up a lot, and then came back to square one. What did we learn? So this is our learnings. Maybe some value investors do not share the full thing here, but it's our opinion. When you go to traditional value or deep value, you tend to end up with cyclical businesses, lower quality businesses, sometimes problematic. Compounding is more difficult when you go to this deep value or traditional value or just picking cheap stocks. It is also more volatile because it's quite related to the cycle, in our opinion. So we understood that we should add a layer of quality. We learned it after, but this is what Charlie Munger was saying in his statements and through the newsletters of Warren Buffett. You could learn it, but it's much, when you see it happening, it becomes evident. So this is why we changed and we developed what we call strategic value. So this is our philosophy of investing. So what did we do? What did we learn? We developed a complete new theory after 2009, 2010. Then we had the European crisis, so it took some time. And this is basically the summary. We invest in what we call the 4 Gs: good business, good management, good balance sheet, a good price. C and D's, concentration and diversification. So we are very concentrated also. I think here everybody is quite concentrated, but we try to look for a lot of diversification within concentration. I will try to explain. RAS, risk-adjusted strategy, we put in different boxes the risk of every company. So we have 4 risk categories, 1, 2, 3, 4. Category 1 would be a basket of Nestlé's, and then we increase the risk. I will explain later. We also look for ESG category, and we qualify them, and we find a huge relation or correlation between good management and good ESG standards. So basically, the analysis is not numeric, how many CO2 tons you issue, how tons you issue. It's more a qualitative and numeric analysis. And we develop the watch list as a circle of competence. If we see a new sector, a new stock coming around us that we like, it doesn't go to the fund. It goes to the watch list. And then we stay there cooking and understanding it for the time we need. This is a slide that I like to put in every quarterly result. It's basically half of the portfolio of the classic. You can see very easy that it is very concentrated, 40% in 10 names. And you have many, many sectors. ISS is cleaning, Grifols is plasma protein, Pandora is jewelry, Leroy Seafood, Salmar are salmon companies, Medtronic is medtech, Unilever, you know it, Reckitt, Beckinsale, HPC, Mowi is another salmon company, Raytheon is aerospace and defense. So, you see, half of the book is really in many, many sectors, in many, many countries. Most of the companies are international. So what we call the 4Gs normally are applicable to all of them. We make exceptions, like in Grifols, very concentrated and diversified. And this is the RAS strategy, risk-adjusted, what we call it. We define 4 risk categories, and we start with that. So the category 1 would be a basket of McDonald's, Nestlé's, Coca-Colas, etc., that normally we buy at a PE of 15 to 20 times. We wait whenever they have a couple of quarters bad, and then we buy them because we think that the franchise is so strong that the business will be back in 2 to 3 years normally. Category 2, very solid companies, non-cyclical, but not at the level of McDonald's or Coca-Cola. So here we put Compass. We are also invested in Compass, and MTU Aero Engines, which is an aerospace company. Category 3 would be solid companies, good companies that generate value over the cycle, but that are cyclical, like a cement company or a bank. And then category 4 is high risk. So as a starting point, we build 50% in 1 and 2s and 50% and 3 and 4s. And then we can move when the market is very expensive. It's counterintuitive. If the market is very expensive, you buy the 1 and 2s. And if the market is very cheap, you buy the 3s and 4s because they have fallen much more. So with that, we can balance a little bit. We are kind of crazy on numbers, so we have DCF and IRR per stock. Risk categories, ESG categories. So we have, for the pool, we have almost a P&L and a balance sheet for the fund. We can tell you what is the expected IRR of the fund. And it behaves very consistently because you have so many assumptions in the portfolio. Maybe you have sales and growth and margins and capex per company on the different divisions. So adding everything, it is very, very consistent. You make a mistake in one company, but in the other one, you make a success. So basically, we find it that over the years, the trading range is 12 to 17%, and the average is 14% return. And the watch list, I'm not going to go here in the detail, but basically we choose the sectors we want to be in, and we choose the companies we want to have in the watch list. We know them well, and then once they enter in a buying territory, we buy them. We don't follow momentum. And this is normally the picture of the book that we can give you. Also, the PE at December, this is December, price earnings 25. Let's go to 25 because we are in June. It's 11 there, a bit more now. Price to versus the market at 15, dividend yield a bit higher, price to book 1.7. So we normally buy at a discount, so normally we trade at a 30, more or less 30% discount. And as a conclusion, I wanted to put some similarities with Warren and Charlie and challenge you to see who's saying what sentence. So strategic value, the 4 Gs. And the quote is, investing is where you find a few great companies and then you sit on your ass. So is that Warren or is that Charlie? So it's probably Charlie, I don't know, because I did that like a month ago. The second is fundamental analysis, right? We do analysis, we understand the companies, we try to understand the sectors, and basically the quote from this couple is, the three most important words in investing are margin of safety, which requires evaluation, which requires numbers, and this is important to have numbers in our view. Responsible investing, so this is easy, this was Warren. It takes 20 years to build a reputation, 1 minute to ruin it, and this is very important to us. We try to be very, very transparent. Long-term view, you can read the quote. This is basically Charlie, I would say also, and circle of competence. Yeah, don't try, if you play tennis, don't try to go to the line, right? You just stay a little with some safety here, and you have the quote that this is Warren quote. So this is the final part of my presentation. The same conclusion as Georg, value beats growth. So this is a famous chart, again, the same but not updated up to 2020. Clearly, value beats growth since the Second World War. But then I said, okay, let's check it a little bit. And I went to the indices from MSCI World to check a little bit more of this performance. So normally, global equities long-term should perform at nominal GDP, let's say 6-7%. This is what we said forever. I checked with the MSCI World, and the performance in '69, so you cannot go much longer, it has been 8%, so we are not very wrong with this nominal GDP growth. But then you have two clear trends, 74 to 2000, 25 years of value, and 2001, 24, 23 years of growth. With the main difference is that the growth has been basically in the last decade. Growth has really done very, very well in the last 7-8 years. So my question is, are we going to have another value cycle for 25 years? We think yes. I mean, there's a lot of indications that suggest this. It correlates with a cycle, with an upturn, correlates with higher inflation and rates, correlates with the commodity cycle, with the capex cycle. So, you know, there's a bunch of signals that tell you that this can happen. The Magnificent Seven, so basically tech and these big guys that are doing fantastic, they are already 25% of the SPX, of the US index, and 70% of developed markets is US, which means that, you know, they are so big that, you know, at some point you cannot grow 10% forever to justify these valuations. So the options are starting to be much more favoring value than growth. I'm not saying that all the business models are wrong. The business model of Tesla will be questioned, in my opinion, but the rest have good business models. And something important for us is that in the end, value and growth, there's a lot of overlap. So it's not really only value, only growth. If you look to the right stock and you pick the right stock, you don't really care that much about that. But value will help us because we are value investors. So basically, for us, nothing changes. We will keep investing in good businesses at the right price, in a value, growth cycle, or whatever. And just a little bit on performance, since we did the MBO in 2019, as Alex was stating, we bought the company from Carlos, although Carlos is still there. We've done 12% per year, very happy, below some of our competitors here, but we are very happy. Our target is 10%. And again, let's highlight the power of compounding. 10% per year is doubling your money every 7 years and multiplying by 4 every 14. So this is the really only way to make up for your pensions or for our pensions or our kid pensions, because there's no other way really to make a 10% per year. So, you know, we've done 12, we are very happy. We think that this 12 is because we are learning, and as Charlie is suggesting here, people who learn and who focus in the long term, they will do rise in life, and we expect to rise with this statement. And in the end, value cycle is coming in our view, and commodity cycle is also coming, and we think we will benefit from that. And final slide from me before welcoming Grifols. This is our offer, a little bit of advertising. So you will recognize the sentence, our preferred latitude is partnership. So this is pure Warren Buffett. Investment philosophy, strategic value. Size, we will not grow that much. We don't plan to grow that much. We would like to be a bit bigger, but not too much, not to be institutionalized. Experience, we have a lot of experience. Risk management, we learned the hard way in 08, as I said. Track record, 10%, that's our commitment. With a risk-adjusted strategy, long-term, obviously. And we try to share with you and with all investors and companies what we do whenever we are requested. So, you know, the partnership is very important in our opinion. when we invest in a company, we are looking for partners, and when somebody is investing through us, we're also looking for partners. So that was my contribution. I tried to share a little bit my experience in 22 years. And now I welcome to Grifols, that is one of the tough investment cases we are going through.
Good morning, everyone, and thank you very much for having us today. Thank you, Marcos, thank you, Alex, and thank you, the whole team, for having us and for hosting us last night. My name is Danny Sagara. I'm Vice President of Investor Relations at Grifols, and I'm joined today with Eva Vidal, who is our Investor Relations Senior Manager. Today we will be sharing an overview of Grifols, our journey over the past years, and our plan and opportunities ahead to continue to drive value for our shareholders. We will be more than happy at the very end of this session, to take, your questions. Before that, but not at the end, I would like to bring your attention, to a forward-looking statement disclaimer. Okay. Okay. Grifols is a recognized leader in biopharmaceuticals, specifically plasma-derived medicines and transfusion medicine. This is more the diagnostic part of our business. Our therapies treat rare, chronic, severe, and life-threatening conditions, many of which are hereditary. We have three, as you can see, we have three business units: biopharma, diagnostic, the transfusion medicine that I was mentioning, and biosupplies. Our biopharma unit consists of plasma procurement, production, and commercialization of plasma-derived therapies. Certainly, it's our largest business unit and a key growth driver, representing pretty much 85% of our revenues and probably a little bit more in terms of profits. Our diagnostic unit provides leading-edge diagnostic solutions for blood and plasma screening and makes up about 10% of our revenues. Our biosupplies unit offers high-quality biological products for non-therapeutic use. Grifols, as you can see in the slide as well, is a top player in a consolidated high-growth plasma industry. This market currently stands at close of 30 billion euros, and we have a market share of 20%, similar to the other two peers in the industry, the leading peers, which is CSL and Takeda. Over the last year, this market has grown at a mid to high single-digit rate and is expected to continue to do so. As one of our competitive advantage, we are vertically integrated, meaning that we are in control of all the steps that go from the donor donating its plasma to the patient receiving its therapies. We collect plasma in our more than 390 centers worldwide. We manufacture it, and then we deliver the resulting plasma-derived therapies to our patients, serving more than 100 countries across the globe. We also have a robust pipeline, including more than 20 assets, to treat conditions in those therapeutic areas, on those 6 therapeutic areas that we have our expertise. As maybe you are aware, the company is led by an experienced senior management team, which has recently been reinforced with the addition of Nacho Avia, a former Olympus executive, as a CEO, and other appointments in key positions, and supported by more than 24,000 employees. Now I would like to focus on biopharma, which is the leading business unit of the company. There is a large unmet medical need for plasma proteins worldwide. And Grifols, we play a really important role in providing these essential medicines. As you can see in the slide, key proteins are immunoglobulins, albumin, and alpha-1. For all of them, which we continue to see a positive demand and continued growth. Overall, no question, US still is the main market by far. But we continue to see an increasing growth ex-US, especially Europe, but also in China with albumin. in monoglobulins represents the largest market, currently making up close to 20 billion euros, if we have a global share of 20%. We see this protein as the main driver of growth, especially considering the expected growth of some of its key indications, such as primary and secondary immunodeficiencies. And also, this is a little bit more technical, but also the remarkable opportunity that the subcutaneous IG, the subcutaneous immunoglobulin formulation offers. Albumin. Albumin is used primarily within hospital settings during surgery and intensive care, but also as a treatment for liver cirrhosis. With a market of more than 6 billion euros, we have close, again, 20% share, with a leading position in China, which is the main market for this protein by far. Finally, our alpha-1 protein treats chronic genetic disorder, but we have a close to 70%, so a really leading position, 70% of market share. And we are really seeing positive momentum in key markets, especially US, but also Europe, for alpha-1 as under diagnosis stands at 90%, which the opportunity, that's why it's so significant. So overall, our portfolio has positioned us to continue to build momentum and deliver further growth. I'm going to go quite quickly on this one, trying to save some time here. We have a strong global footprint, and we have strengthened and diversified our presence over the past few years. As mentioned, we have fully integrated the journey from donors to patients into our operations, with more than 390 plasma centers globally, as I was saying, but also 6 manufacturing plants spread across US, Europe, Egypt, Canada, and China. We have 13 R&D centers, pretty much located in 4 hubs, 2 in the US, North Carolina, California, Europe, in Germany, but also in Spain, and China through Shanghai RAS. We will talk about Shanghai RAS a little bit later. Okay, that's the most important. I think that the next 2 slides are the most important one together with the last one. So what happened in this company over the last years? It was kind of like the perfect storm. The COVID-19 was a difficult time for the entire plasma industry, including the company, including Grifols. We were faced with the initial outbreak in Q1 2020. The government lockdown and financial stimulus programs, especially in the US, prevented donors from donating plasma. Actually, our plasma supply dropped by 20% in 2020 and 2021. And the challenge number 2 is that we got a significant increase in the cost per liter of plasma. It increased in the range of 30 to 40%, peaking in July 2020. Which means a huge increase in a really short period of time. Certainly, it had a direct impact on our EBITDA. As I said, we were right in the middle of the perfect storm. But there is some hope here, right? In 2022, we were well on the road to recovery from the main impacts of COVID-19. Starting mid-2020, plasma collections started to rebound significantly, and as a result of this, we saw plasma supply increase of 20% only in 2022. I agree that the baseline was low, but an additional 10% in 2023. Q1 24, an additional 8%, if I'm not wrong. So certainly, as you can see in the graph, today we are collecting on a weekly basis more than what we were doing back in 2018. Regarding costs, we implemented an aggressive operational improvement plan that is yielding more than 450 million euros in annual cash cost savings. 450. Most of these savings, no question, were on the plasma area, including a reduction of donor compensation, donor center rationalization, but also process efficiencies. As a result, Q1 2024, cost per liter had declined more than 20%, roughly 25% compared to July 22, which was the peak. Today, having left behind all these impacts, plasma collection have increased significantly and cost per liter continues to drop. So we certainly believe that the company is on track to further expand its profitability. And I cannot wrap up, my part, without bringing some additional numbers here. As you can see on this slide, the financial performance turnaround story is clearly reflected in 2023 within 3 fronts: revenue, EBITDA, but also our leverage ratio. We delivered 6.6 billion euros in 2023, which was an 11% growth at constant currency versus the prior year. And as said, mainly driven by the strength of our biopharma business unit. As you can see in 2024, our guidance, we expect, and we are on track of it, to deliver more than 7 billion in revenues, which means more than 7% growth at constant currency, driven by biopharma, which is expected to grow in the 8 to 10% range. Our adjusted EBITDA reached 1.4 billion in 2023 at a margin of 22.4%. As said, driven by continued revenue growth, cost per liter reduction, increased efficiency, and operational leverage. We are confident, we remain confident in our ability to continue to expand our margins, and we are expecting our adjusted EBITDA to exceed 1.8 billion in 2024, alongside a 25 to 26% margin for the year. So again, as you can see, I would like to highlight, that as you can see in the graph, the margin expansion is quite remarkable here. Finally, we got to say that we remain focused on reducing our leverage ratio, and a testament of this track is that we are able to reduce it organically to 6.3 times in 2023. It's true that it is compared to 9 times, which is quite high, that we reported right after the acquisition of Biotest, which was a kind of like a transformational acquisition for the company, but it's true that it took place in the first half of 2022, and as you can see in the graph, the EBITDA at that point was quite impacted by all the impacts that I was mentioning related to the COVID-19. We are targeting 4.5 times by the end of 2024, driven by 3 levers. The proceeds from the 1.6 billion euros with the sale of the 20% of Shanghai RAAS, our stake that we have in China, which will be closed this month, June 2024. Organic EBITDA improvement, as you can see in the graph as well, but also cash flow improvement throughout the year. So thank you so much for listening to me, and I will now pass you over to my colleague, Eva.
Hello, thank you. I'm going to try to be very, very executive as I'm very conscious of time. Thank you very much for having us here today. I'd like to cover a little bit the future. So we've seen that Grifols has faced many challenges and overcome them, but now I'd like to focus on what's ahead. The company is facing a new chapter of profitable growth. So as we look into 2024, the plasma industry continues to be very strong. The trends continue to be very favorable. So in terms of collections, they are expected to continue to favorably grow sustainably. Cost per liter is expected to stabilize going forward too, on top of some efficiencies and increasing yields that we are expecting also to achieve. This also leads us to say that the company is very confident on achieving the guidance that Danny has covered briefly previously. So we are expecting to achieve that also for 2024 in order to continue growing and expanding our margins. Aside of that, the company has 2 main top priorities. First one is debt reduction. So on the one side, the company has announced recently the private placement notes amounting to 1.3, which will clear the way until 2027, as the company is now committed to tackling its 2025 maturities. And another evidence of that is the Shanghai RAAS deal, which is expected to close this month, and it will provide us with 1.6 billion euros that will certainly contribute to reduce our debt. Also, another priority is cash flow. We are very conscious on improving our cash flow, and the company currently has a plan in place in order to enhance cash flow on 2024 as well as on the years beyond that. Another important area to mention is governance and leadership. As Danny has mentioned, the company has a new CEO, Nacho Avia, who will certainly be an important person in this new next chapter of growth. So also another important thing is that the company has separated ownership from management, as well as the roles of executive chairman and CEO. In terms of leadership, the company has reshuffled its key management positions, such as innovation, biopharma, or digital. And I'd like to cover also briefly the commercial expansion and innovation piece. The company is focused on unlocking further opportunities from its key proteins, such as immunoglobulins or alpha-1, as well as continue to accelerate its pipeline. And I'd like to highlight 2 key proteins that will be launched in the market soon, which are fibrinogen and trimodulin, which will certainly contribute significantly to our margin expansion. And last but not least, simplification is key. The company is really focused on simplifying its processes and structures in order to be more cost-effective, leaner, and more streamlined. So all in all, we think that the company is very well positioned to increase further value for its shareholders. And linked to that, I wanted to end the presentation with a very important slide to us, in which I would like to convey a message which I think is really clearly represented in these 2 graphs that I think they talk by themselves. So the company trades at a really significant discount, as you can see on this graph, both comparing the EBITDA multiple to historical performance, as well as to other peers in the industry and in the biotech and the pharma industries. So this discount is hard to explain by itself. We think that it offers a significant opportunity. And I'd like to end by saying that the company has changed. We are operating in a very high growth industry. We have strong fundamentals. We are one of the 3 main players in the industry with very high barriers of entry. We've changed our management, our governance. We have really commercial, a really good commercial portfolio, a really robust pipeline, and we are really very well positioned for this new chapter of profitable growth. So thank you very much. I hope I've been quicker enough. Thank you.
Because we got out of time, so I will ask only one question, if I may. So this question is, because we talked about leverage, you showed the 4.5 times leverage this year, but there's, is there a risk with the sale of Shanghai RAAS? This would be a quick question. Is there a risk not getting this 1.6 billion that everybody expects? And the second question would be, what do you think about the research of Gotham after 6 months dealing with the short selling story, with all the investors, with the share price down 40%?
Okay. The recommendation is that you cannot say yes or no to any question, but I'm going to make an exception to myself, and the answer to the first question is yes. China will be done this month. We don't have any major concern. I mean, it should be something such unexpected that we are not even considering. On the Gotham one, I mean, I don't think that the Gotham thing is going to make any change per se, but probably it's going to accelerate some changes that were already approved. The fact that we have a new CEO, since April 1st, it has not been because of Gotham. I mean, it will not make any sense, to think that in like 2 months we can hire, such a exceptional executive like Nacho in 2 months. So the roadmap was set in 2023. All the main decisions, including the separation of ownership and management of the company, was already taken. Some sort of acceleration because of Gotham, I cannot say no.
Okay, thank you.